Welcome to TradeTheMBA.com. This is John. This report is for the 23rd of June. Not a surprise. Okay, so we had the magenta crossing back above as we were at the bottom here. And it was just a matter of literally beginning to see the turnaround of that magenta. As it started to build, we could tell that we were likely to face a move back up towards the 23%, though we knew that it would be literally that would become the test point based on the DOC from its super depth. Sometimes you get an immediate spike, but often those just hit the 23 and pre-market. So the continuation of that, even with the declines that were starting to take place during yesterday's trade, we're still looking at it pretty strong. MBI reading from the magenta rising, even though red was matching it. That's a little pressure on it, but doesn't stop that. The DOC confirmed it with the green moving over cyan, and cyan dipping below 7.5 here. Literally indicated bulls had much more strength, and of course the DOC orange dip of below the red certainly cemented that, and there's the steady rise in the shakeout indicator, and getting above negative 13.5 is always critical for that eventual mass. Now, of course, we still haven't reached that 3850 level, which was that same previous level, and I had the range that was around the 3850 down to around the 37. We dipped a little further than that. Okay, not a big deal, but certainly in line with exactly what the expectation from the readings are, so no objection to that. The fact that the steel up so high actually becomes an interesting one, because it's going to take quite a bit of a move on the short side and fate of short-term buyers for us to see that steel cross below cyan, which would be weakness signals. It could take a little bit longer. We'll see how much momentum it gets out of it, but certainly if the bull case is stronger than it's been in some time, given what we've seen, doesn't mean it's going to last for forever, but at least it's an indication that there's some interest developing in a real way. From an NQ standpoint, not quite as dramatic move from the MBI reading, but matching DOC except for the failure of the orange to dip below red. So this looks like the NASDAQ will end up being slightly weaker overall. But it already has, it's 23% much lower anyway. And of course the euro, again, you get these prop-up moves where everyone sees that floor and they jump at it. It's just not easy to sustain it because there really is zero appetite for anything coming out of Europe at this particular stage, and nothing they're doing is encouraging for growth aspects. So again, even if there are problems in the US, it's far worse in the Eurozone because people need dollars. And we're already seeing a drying up liquidity-wise of dollars available out there. So this is another one of those behind-the-scene credit crunches like we had when all that liquidity dried up and the Fed had to take over from the banks and started offering those overnight loans. And so this is that same kind of credit risk is starting to rise intra-party, something I mentioned a couple of weeks ago, and I think I just saw another article out on it just the other day. And that's real troubling because, again, this is the indication that counterparties aren't trusting each other, that they'll be able to pay back. So rates between institutions and that are rising dramatically. And that just creates an instability because then you get what is just a credit freeze. So from a gold standpoint, that's not super bullish for gold, despite the inflationary aspects that are still taking place. You have the potential for midterm deflationary aspects, something that we've discussed, and we'll know probably towards the end of summer or maybe even sooner if it's really bad, if there are liquidations from companies in that, or just a series of closures, either based on lack of supply, inability to get a product, a whole host of reasons, but inventories may have to be lightened up, that kind of situation. That would be where you would get discounting to just get stuff moving. And problem with that is being able to resupply it. It's not going to be easy, particularly anything in the consumer electronics area. And that, I mean, you just go down the list of all the metals and that are needed that Russia is a primary supplier of, that just won't be bought anymore from the West, and it just puts a squeeze on what's available. So oil has seen a little bit of a retrace here back down to the 50% range, still above 100, and that becomes still again the threshold. So we've kind of capped out at that 120 range seems to be the intermediate push barring any kind of situation. Now, the Kaliningrad situation heats up and the Russians decide they're not willing to allow a blockade of goods traveling through Lithuania to reach their colony, or well, actually it's still part of Russia. It's just a detached portion, sort of like Alaska to us. It's sort of like Canada saying, no, we're embargoing you and you can't run things through Canada any longer. It would not sit well. Everyone would say, oh, you can go buy water though. And it's like, well, yes, but you also have treaties and that were signed and agreed to before Lithuania went into the EU, saying that they would allow free transit of goods and that. So, yeah, it could be a powder keg from that standpoint, because it just, as the Ukraine situation continues to fall apart for the Ukrainians in the West view, the Russians will be freed up in not too distant future if this persists. So there's going to have to be somebody stepping to the negotiating table. It's unlikely to be the West because, at least from the U.S. standpoint, it serves all of their policy goals. So flight into the treasuries here, causing the yield to drop a bit because people are obviously looking for safety. And this is that ebb and flow we're going to get with that as people shift resources. And so when you get these spikes, you know that it's just people wanting to suck up that return. It's not that interest rates are looking to fade anytime soon, because that just isn't the reality of it. Bitcoin still, started to make its push. Clean sell signals came through, though, pushed us right back below the 20K number again. But that's actually positive in testing that. It's just a question of will it be able to maintain it? And every time we seem to get towards the 50% peaks in that, we start to get a little bit of softness in there. Before we had a nice shakeout on the lead up, really creating a nice little push that pushed it back up to 21.7 range, but it's getting a little bit softer each time. And so effectively matching highs here at the 50%, lower readings from a MBI standpoint. Shakeout modestly better, barely positive, but if that flips back to negative, I would expect to dip all the way back down again without much resistance at all. From an ETH standpoint, same situation where we're getting these just nice reads, and it's just a matter of following those trades. If you're looking for a broader perspective as to where they may go, they look at that over the weekend and give you a broader perspective on the crypto space. But look at how small these ranges are going to be moving to. So there's just a bit of dry up of liquidity. We started off with the sell signals there, and you can see the giant push up here right at that 50% retrace from the peak. And that's currently where it is right now, red leading that one. From an intraday standpoint, you can see here in the post-market, we started off down at that 37-35 range, and that's what caught the bid going up forward. But from an intraday standpoint, which is beautiful ranges, so it's some nice sell signals, some early buy captures that I was working on, some of the adjustment code that's working pretty well. You just have to have the flip over change a little bit sooner, and scrolling back through, we had just a few more of those setups, but some nice runs early on. We were posting these ones and then just went a little bit back and forth. All pretty clean action. I think everything's pretty set with there. And if I completed my testing on the updates that I may send them out earlier for you so that you'll have them before the end of the month, get a chance to see it. Literally it's just going to make things easier, having to have fewer programs on any given chart, but just being able to turn on and off the features of some of the visual indicators. That way you can just turn them on at will and not have to worry about adding extra programs. And I think that should add to speed and efficiency. Not that everybody's getting their charts overdone, but just as a cumulative effect, if you have a lot of workspaces or multiple charts, it should make things even better. As always, though, look for you on Skype chat. Trade well. We'll talk to you later.